There are countless ICT trading strategies available. The challenge is that many are overly complex and difficult to implement in actual trading scenarios. Through thorough backtesting and live market experience, we've pinpointed a few methods that perform remarkably well and remain easy to execute. In this video, we're going to walk you through 4 of the most reliable ICT trading strategies. You'll discover what they are, the mindset behind each, how to identify them on the chart, and the correct approach to trade them for optimal outcomes. So, if that sounds valuable to you, be sure to smash that like button to support the channel. And if you're new around here, don't forget to subscribe for more actionable content. Catch you right after the intro and disclaimer. Number 1 is the silver bullet trading strategy. This setup ranks among the most powerful smart money concepts. It blends liquidity principles, market structure shifts, and fair value gap entries into one cohesive approach. In a bearish setup, the price initially rallies above the day's high, sweeping liquidity. This signals that the market is targeting liquidity zones above the key structure of the day, typically the highest point reached during the Asian or London session. We then anticipate a bearish market structure shift, which hints at a potential downward reversal. This confirms the end of the upward move and marks the beginning of seller dominance. At this stage, we focus on a fair value gap as the ideal zone to enter a short position. The psychology behind this method revolves around institutional trading behavior. Big players need buyers before they can sell. To achieve this, they drive price above the day's high, triggering stop losses and attracting breakout buyers. Once enough liquidity is secured, smart money reverses the trend, sending price downwards to chase the sell-side liquidity beneath the day's low. The same idea holds true in a bullish setup. Initially, we want to see price dip below the day's low, clearing out liquidity. After that, we wait for an upward market structure shift, which indicates a potential reversal to the upside. Once this shift occurs, we pinpoint optimal entry zones for a long trade. These are typically fair value gaps. To apply the silver bullet method, open any chart in TradingView and switch to the 5-minute time frame. Right-click on the chart and select Settings. Under the Events tab, enable Session Breaks. This will display vertical dividers for each trading day. For example, here's the euro-dollar on a 5-minute chart. Start by identifying the high and low of the current day prior to the New York session. At the top, we note the highest price from the Asian session, and at the bottom, the lowest price traded so far today. As New York begins, we notice price dipping below the day's low and quickly snapping back into the range. This could be a liquidity sweep. But for a solid reversal confirmation, we need a market structure shift, specifically, a break above a recent supply level. Continuing with the chart, price drops a bit more but then rebounds back into the range, and this time it breaks above the recent supply zone, confirming the bullish reversal. So where do we find the high probability entry? The most recent push created a fair value gap. This now acts as a demand zone if the price revisits it. We'll place a buy limit at the start of this gap, with a stop loss just below the swing low. For take profit levels, we'll target major resistance zones ahead. Now let's walk through the silver bullet strategy again, step by step. First, mark the high and low before New York opens. Next, watch for a liquidity sweep beyond these levels and a return into the range. Then, confirm a reversal with a market structure break above a supply level. After that, locate a fair value gap, set your entry inside this zone, and target key resistance areas. Now let's dive into the next concept, the turtle soup setup. This setup is another high probability strategy that blends market direction, liquidity sweeps, and fair value gap entries. A bullish turtle soup pattern takes shape when price dips below a recent swing low, or a cluster of lows, while holding above a bullish fair value gap. On the flip side, a bearish turtle soup occurs when price runs above a recent swing high, or a group of highs, while staying beneath a bearish fair value gap. The logic behind this approach is quite straightforward. Think of a market in a strong uptrend. For institutional traders to accumulate long positions, they require sellers. That means they need to tap into liquidity zones. So where does this liquidity sit? It's located beneath swing lows and above swing highs. Traders who went long at those points usually place their stop losses right under the lows. When price retests those areas, it builds up more pending orders, and more stop losses. Once price gathers enough of that liquidity, it has the energy to propel upward again. If it doesn't, the market will keep sliding lower, stacking even more liquidity zones for the future. By collecting sell-side liquidity, the market fuels a potential bullish continuation. That's what gives the turtle soup strategy its edge. It leverages liquidity pockets for reliable continuation setups. Things get even more compelling when a fair value gap is positioned just below one of these liquidity pools. That's where a high probability opportunity is often found. Because liquidity tends to form beneath support, there's a good chance price will breach that support, sweep the liquidity, and then reject off the fair value gap with strong upside momentum. After this bounce, price usually gains traction, pushing higher and continuing the trend. This method offers a sharp way to trade with the trend while using liquidity grabs and fair value gaps to time precise entries. Here on the pound 5 yen minute chart, we observe a strong upward movement. Typically, a break below the recent low would suggest a market structure shift pointing downward. But if you glance to the left side of the chart, you'll find a fair value gap, FVG, positioned just beneath that swing low. This setup increases the chance of price dipping below the recent low to collect liquidity before reversing upward from that fair value gap. Once again, take note of how price creates a pool of liquidity directly above the FVG. All the ingredients are in place for price to reach into sell-side liquidity, tap the FVG zone, and bounce upward. Naturally, this won't play out perfectly in every instance. Still, the turtle soup setup is great for capitalizing on fake-outs and catching price as it shifts back into alignment with the prevailing trend. Now, let's move on to another key idea: change in state of delivery, also known as CISD. So, what exactly is a change in state of delivery, CISD? CISD is a type of reversal pattern where price momentum shifts sharply in the opposite direction, hinting at a possible market reversal. Take this example. We're in a clear bullish trend, with recent price action showing strong buying pressure as price breaks above a previous high decisively. This confirms that demand is firmly in control. We highlight the body of the first strong bullish candle as a reference for the start of this move. With the structure leaning bullish, we naturally expect price to continue higher after a minor retracement. However, if price suddenly drops and closes beneath a key demand level, invalidating the previous bullish push, this is what we call a change in state of delivery. So, what does this mean from a price action perspective? First, it suggests that the breakout wasn't genuine, it was a liquidity hunt above a structural high. Second, the break below the demand zone shows that buyers failed to hold their ground, and control has now shifted to sellers. This sharp transition signals a potential shift to a bearish market direction. Now, how do we apply this in a real trading scenario? Once CISD is identified, our bias flips bearish, and we begin scanning for short setups only. Since the former support zone has now become resistance, we can use this structural flip to plan an entry. When price retests this newly formed supply area, it provides an ideal shorting opportunity, capitalizing on the downside momentum. The same logic holds in a bearish to bullish reversal. It's worth noting that although CISD and change of character, CHOCH, seem alike, they serve slightly different purposes. CHOCH is based on breaking well-defined structural levels and indicates a shift in trend over time. CISD is more about catching a sudden loss of momentum, which can hint at a reversal even earlier than a typical CHOCH. That said, not every CISD setup is trade-worthy. If the pattern appears without proper market context, say, in a choppy zone or without structural relevance, it can lead to low-quality trades. To use CISD effectively, it must align with other market elements such as liquidity zones, market sessions, and fair value gaps. After thorough backtesting, we found that CISD setups are far more reliable when they appear under specific market conditions. So next, let's dive into the key rules and confluences that increase the accuracy and win rate of CISD-based trades. Checkmark rule number 1. Rejection from a higher time frame key level. As we've established, CISD is most effective when it aligns with major price zones, especially those marked on higher time frames like the 4H, daily, or weekly chart. These zones carry institutional weight and have the potential to influence price action heavily. When a CISD forms after price has tapped into such a significant level, it signals that the market is rejecting this key zone, making the potential reversal far more credible. Without the higher time frame context, the CISD could appear in a random or weak area, reducing its effectiveness and the overall probability of a successful trade. Checkmark rule number 2. Liquidity sweep before the shift. High probability CISD setups often emerge after the market grabs liquidity from either side. Liquidity pools naturally form around equal highs or equal lows, areas where retail traders place their stop losses. When the market sweeps through these levels, it triggers stop hunts, gathers liquidity, and prepares for a shift. This liquidity event acts as a catalyst, allowing smart money to reverse direction with sufficient momentum. A CISD that follows such a sweep is much more likely to play out, as the market has already cleared out one side of the order book. Checkmark rule number 3. Confirmation through volume and fair value gaps, FVGs. A reliable CISD setup is often backed by volume and momentum confirmation, both of which can be seen through the formation of fair value gaps. Let's say the market breaks out with strength, leaving behind a bullish FVG, signaling strong upward momentum. Suddenly, the price reverses, closes below the demand area, and forms a bearish FVG in the process. These imbalances indicate aggressive trading by institutions or major players. When CISD appears alongside FVGs, it adds significant weight to the idea that large participants are behind the move. A retracement back into the FVG zone often becomes a high probability entry point, as price tends to revisit these imbalances before continuing in the new direction. By combining volume, fair value gaps, and CISD, you're aligning with the momentum of institutional money, boosting both your edge and your risk-to-reward ratio. By adhering to these rules, ensuring the CISD forms at a key level, confirming with volume, and patiently waiting for a retest, you significantly enhance your chances of spotting high-quality trade setups with strong profit potential. Now, let's shift gears to ICT's optimal trade entry (OT) strategy. This method primarily leverages Fibonacci retracement levels combined with key swing points to forecast the start of powerful impulsive moves and to establish potential target zones. Picture this: we're in an uptrend, aiming to buy low and sell high to capitalize on the bullish momentum. Jumping into a buy trade immediately isn't ideal since the price is currently elevated and could pull back at any moment. Instead, it's wiser to wait for a corrective pullback to enter at a more favorable price. The latest impulsive move began here and pushed price up to this point. The correction is expected to unfold within this range. Once the market absorbs enough liquidity and buyers re-enter, price is likely to resume its upward trajectory. The critical question is, where exactly should we enter our long position? Enter too early, and the price might drop further, stopping you out despite the overall bullish setup being valid. Wait too long, and the move might have already reversed, causing you to miss the trade. The key to trading with the trend is pinpointing the end of the correction, the precise moment when the next impulsive move kicks off. So, how do we identify this point? This is where Fibonacci retracement levels become invaluable. By applying the Fibonacci tool from the start of the impulsive wave to its peak, we outline the correction range. Several retracement levels appear, each acting as a potential support zone. However, two Fibonacci levels stand out as ICT's optimal trading zone, OTZ, the 61.8% and 78.6% retracements. These levels provide multiple advantages, including improved risk-to-reward ratios, safer entries, and more strategic stop-loss placements. To take this further, let's combine the optimal trade entry concept with fair value gaps, FVGs. Imagine a clear uptrend where we patiently wait for a pullback to enter a long trade at a better price. If the price dips below a certain level, it could signal waning momentum and threaten the uptrend. By applying the Fibonacci retracement, we define the correction zone and highlight the OTZ. Looking to the left on the chart, you'll notice the recent impulsive move has created multiple fair value gaps, one of which coincides with the OTZ. When price retraces into these FVGs, they act as robust support zones, increasing the probability of a bullish continuation. For a more conservative approach, you might place your buy limit order at the third fair value gap within the OTZ, reducing the risk of falling prey to liquidity traps. In summary, combining the optimal trading zone with fair value gaps allows you to identify strong supply and demand areas, leading to higher probability trade setups with better risk management. That wraps up today's lesson. If you found this helpful, don't forget to like the video and subscribe for more actionable trading insights. See you in the next one.